Good evening, ladies and gentlemen. We shall let everybody just cruise into the room. In the meantime, we shall have a look at the markets for a few minutes just to see what's going on. I've been watching them, Nvidia, normal chugging to highs. That's an incredible story, isn't it? $3 and a bit trillion market cap. We're at Juneteenth holiday tomorrow in the US. I'm looking at my other screen, by the way. Come in, welcome. Get yourself comfortable, get yourself ready, get yourself prepared. We'll get started at 6 o'clock on the dot. Nasdaq chugging along, not doing awful lot today, as expected before holidays. Nothing crazy is happening. What else is catching my eye? Natty up 3.5%. It's natural gas always seems to be up when we do these webinars. Maybe there's a correlation there. What else we got knocking about? Tesla struggling. Tesla's been in that range for so long now. Tried to break out of it, couldn't really get going. Got some good chart examples of Tesla in a moment, actually, for this webinar when we get started in a moment. GME, anyone trading GME? What a funny old game that is. Who would have thought? We've got a guy with a headband called Roaring Kitty who's trying to manipulate stock prices. Why is he manipulating? I don't know. That's another discussion for another time. Anything else in the land of Forex? What have we got? Pretty quiet day. Pretty quiet day. Okay. So we'll get started. Not so many in here. I haven't got the correct link. But we'll get started anyway. The recording will be going out if people aren't here. Maybe people are watching the markets and falling asleep. Rowie says your last podcast was awesome. Thank you for that. Cheers, appreciate that. Change things up a little bit on the podcast. I think I might do a mention on this and just say I'm going to decrease the frequency, but try and be a bit more specific about some of the things we do, all the things I talk about. So that I think that'll help people. But anyway, it's not about my podcast today. This is about mastering the art of scaling. I'm just going to check that we do have correct links. Bear with me, ladies and gents. We'll get started in 2 minutes on dot. Don't worry. Let me just... All right, let's go for it anyway. Okay, so 1 minute, we'll get started. All right, today we are going to talk about another one of my favorite topics. By the way, if you haven't checked out my last webinar, the last one I did was VWAP trading strategies. I loved that one. I got so much great feedback from it. So thank you for that. That's very kind of you to give me that feedback. I think that, like I said, and there that the VWAP is one of my favorite indicators, if you could call it that. I really think it's such a useful. I talked about why I think it's important to look at, why institutions look at it, and some of the ideas and strategies from there. Some feedback from people who said they developed different strategies from it. Implemented it into their own trading. So that's great, and they're getting some good results from it, which is great, which is really good. I like to hear that. Today we are talking about mastering the art of scaling. Now, we'll start 20 seconds early, shall we? Okay, mastering the art of scaling. So listen, honestly, I think a lot of traders who are developing are, I overuse this phrase, I admit, playing the game on hard mode because they're trading all in and all out. And it's so difficult to do that. You have such a challenge when you are in the trade. Do I take it? Do I not? Is it the right place to take it? Should I wait a little bit? If I wait, I'm going to get an awful risk-reward ratio on the trade. If I don't wait, then when you're coming out of it, a little voice saying take the profit, you're going to lose the profit. Another voice saying this could run on. It's very, very difficult. When it's an all or nothing decision on both sides, the entry and the exit, I think it's so hard. So hard. And maybe, there's an argument to say that actually traders, if you force some experienced traders to go back to trading one clip at a time, they might struggle. It's very, very difficult. So maybe today I'm going to put forward an argument to implement some kind of scaling strategy into your own system. And of course, it's entirely up to you. You're the you're making the decisions for your own strategy and your own risk tolerance. So, don't take my approach on stuff as gospel. I don't tend to know everything. Yes, I've got 20 plus experience, 20 plus years experience trading the markets. Yes, I work with traders and have a community of traders, and so I see lots of mistakes and things people make. But that doesn't mean that you should just take what I say and go, "Oh, he definitely knows what he's talking about." Learn, think about it, go and explore yourself. And hopefully that's kind of what I do with these webinars is hopefully spark an idea in your mind where you go, hey, you know what? That's interesting. Let me go and explore it some more. And that's my objective. So before we get started, of course, we have to explain about the risk that comes with trading. If you're trading spread bets or CFD or any product on margin or leverage, you got to be careful. You can make a lot of money, you can lose a lot of money. That's the nature of the game we're in. If you understand that, then carry on listening. If you don't quite understand it, that's okay. Just go and make sure you do before you place your first trade. I know we often get some new traders coming on here, some developing traders. Many of you are very, very experienced. You understand the nature of the game. You understand how margin works, leverage works, and the risks involved in this business. Good. But I just always want to make sure that if you are playing this game, if you are getting involved, do just understand it. I'm not one of these people that says you should definitely just go out and try and do this. No, no, no. It's not for everyone. And I hate to hear when people have the stories of I didn't really understand what I was trading. It wasn't quite clear to me. I think it's like anything that has risk in it. If we understand the risk and we choose to participate, then that's fine. We're adults, right? And I like that about society. We should be able to make our own decisions, right? If you want to go boxing, bare knuckle boxing, then you go bare knuckle boxing. But anyway, hopefully you understand the risks involved with this game. Okay, so Stanley Druckenmiller says, one of the most important aspects of risk management is knowing when to scale in and out of positions to adjust exposure based on market conditions. And there's some more quotes in a moment. Just a quick reminder, ladies and gents, what we'll do is I'll talk for around 45 minutes. I've got some great slides for you, some good examples to kind of visually, hopefully help you make sense of some of the things I'm saying, some sort of text to kind of support some of the things I'm saying. So the different ways that we learn and we take in information, hopefully we've covered them all. And as always, if there's any questions, put them in the Q&A section in your box, wherever it is, somewhere in Zoom, sure you can work it out, and I'll get to it at the end. If I will do my very best to answer it. If I can, I will. If I can't, I will direct you to someone or somewhere who can. So you'll definitely get some help with that. All right. I don't have all the answers. Reminder, I think I've mentioned this. I'll share with you ideas and thoughts. Always doing your own research and stuff. It's never a recommendation or advice, of course. Things take time. If you're going to implement a change, let's say you do decide to kind of implement some scaling strategy, think about it, consider it carefully first, decide if it's right for you, run with it for a while, observe the results, and then make kind of course corrections from there. I'm just going to double check I'm on the right microphone. I'm good. Okay. So here's a selection of quotes from some of the greats: Paul Tudor Jones, Bruce Kovner, Peter Brandt, Linda Raschke, Marty Schwartz. His book's behind me. There's the top one, Pitbull. Really recommend that. Jack Schwager, of course, Market Wizards book. I'm not going to go through all these quotes, but all these guys, and there's a girl in there, say, hey, scaling in and out allows you to be more flexible, allows you to play defense more effectively, manage risk more effectively, lock in profits, reduce risk. Risk is the commonality here. Marty Schwartz talking about scaling into a trade gives you a better chance to profit, minimizing your losses. Jack Schwager saying that scaling in and out trades are technique. So listen, it's not something we've just made up here. It's something that the great traders before us, great traders still trading now, many of these are all still around, suggested that they're long gone, they're still around, but many of the great traders are advocates for scaling. So how can we get better at scaling? That's what I'm trying to cover today. Different types of scaling, scaling in, scaling out, entries, exit. And I'm going to cover a lot of ground with a lot of examples. And the idea is hopefully you can take some notes or think some ideas and go away and go, actually, that fits my style of trading. I want to improve my scaling. You're probably in one of two camps, actually. I already deploy scaling to some extent, and I'm trying to maybe get better. And hopefully this webinar will give you a few ideas to improve your scaling efficacy. Or you don't scale at all. You just kind of all in, all out, and you're kind of wondering, oh, should I consider scaling or not? So I think scaling is a skills we mastered. And I look at it in four segments, right? You've got scaling in, and in those two segments, you've got price going against you, i.e., let's say you're long, and against me means um, going down. So it's going lower and lower and lower. So it's going against me. I'm now in a losing position and I'm scaling into that trade as price goes against me. A word of caution on that in a moment. Just hold that thought. And price going in your direction. So you're long, price is going high. You're adding to the position as it goes in your favor, otherwise known as pyramiding, right? And then scaling out is taking profits or taking losses. So taking profits is obviously if you're long, market going in your favor, hits a level, you might peel a third of the position off. You might peel a clip off as it goes up a certain percentage, a certain period of time, and you might scale out a position as price starts to go in your favor, and your average exit price is kind of aggregated over those exit positions, depending on the size of the position, etc. You know, the maths works on that. And also taking losses. So the market goes against you. Most of us traders do an all in, all out, especially all in, all out, especially if it's a stop loss. So let's say you're doing 10 units, whatever that unit may be, £10 a point, 10 lots, 10 CFDs, whatever, and price goes against you. Most traders have a stop loss for 10 and will take out the whole 10. We're going to discuss different ways of kind of approaching these four different strategies and how scaling can improve that to a certain extent. All right, so let's start with number one, which is scaling in to improve the position. So have I flipped the terminology on you here just to confuse you? Hopefully not. So what we're doing here is we're basically scaling in at a worse price. So as price, let's say we buy 100, we're buying at 90, buying at 80, buying at 70. Just hypothetically speaking, that's what we're talking about here. Scaling in to improve the average position price. Now, one thing, okay, let's start with the good side of this. If you do it correctly, it allows you some leeway with your entry precision. Okay, so in other words, you don't have to be perfect right off the bat. You can say, you know what, that feels like a good level. Let me add a clip on. Let me see it going a little bit further. Let me add some within a zone. We'll talk about a zone in a moment. So imagine if you've got a £4 a point position on a spread bet, you could do 4 times 1, or you could do 2 times 2, whatever, how you want to split it up. You can split up your anticipated order size into tranches. Okay. Now, I'm going to head to this warning first because it's very, very important, this. And I want to say it now. I think I added it at the end, but I think I want to say it now because this catches so many traders out. So one thing a lot of traders do is, and listen, hold my hands up, early days, I've done this, and you may well have done this too. And I can see some people nodding and going, yes, I have, is scaling in with no real plan. So as the price is going against you, you're adding another clip, another clip, another clip. Before you know it, you have more than you really wanted, and you're in an unfortunate position where you're very, very sensitive to price movements. Price has one last little exhaustion flush. You can't take it anymore. You're trading your P&L. You see the unrealized P&L at an unpleasant situation, and you end up exiting the position in a kind of frustration. You go until all sorts of stuff happens. So one word of warning here, if you're scaling in to improve your position, you have to be very, very disciplined. We don't want any scaling in that's kind of random. We don't want any non-structured scaling in. We have to do this within a very, very focused and concise approach, which we'll cover in a moment. But I wanted to make that clear because this is something that can catch people out. And I've seen people do this. Like if I liked it at 20, I'm like it at 18. If I liked it at 18, I love it at 16. If I love it at 16, I love it at 15. We don't appreciate that trends can go on way, way longer. That old quote, trends can remain in existence for longer than you can remain solvent, is very, very key. So, it never works out. So be very, very careful. I'm talking about some tactics of how we can really get good at this, but I wanted to make that as a warning first before we move on. So be careful. Okay, so example, let's imagine here you're trading Pepperstone's NASDAQ product or NASDAQ equivalent. You say, right, and this is, again, a hypothetical kind of picked out example just to sort of illustrate how you might do this. I'm going to show you the perfect one and one that catches you out. And kind of some tactics to maybe improve that win rate. So let's say you wanted to add on this double bottom here. So you had your first clip here, and then maybe you're adding every $10 lower. So you've got one here at 506.9. You add another $10 lower. You add another $10 lower, another $10 lower. You've got 4, just going back to that example, say you were doing £4 a point. It was a spread bet. Great. Now you've got your full size clip. You're not adding any more. And in this example, cherry picked, of course, just for illustration purposes, market comes to push back up, and there's your exit. And imagine that was a thesis anyway. The thesis was it was a kind of a rotational type environment. You're looking for a little test, a little kiss of that prior low, wicks through, bounces back up to a mean, in this case, VWAP, going back to the previous webinar talking about VWAP. We love the VWAP. This would kind of how you'd implement scaling in this. So you might not know, hey, where is it going to bounce? I don't quite know how to judge this. So I'm going to spread my order over at $10 at a time and do 4. And in this case, great, right? Your average is right there and it's pushing back up and you're making a decent trade on that one. Doesn't always work that way. Here's one where you got 1. So let's say you're trading that kind of double bottom a little bit below the low. You got filled on 1. You didn't get filled on the second. You're up. You take your exit out of the VWAP. You've only got filled on a quarter of the position. So one of the downsides is that if you're right, you might be right on a quarter size, but if you're wrong, you're always going to be wrong, biggest on your losers. This is why this is such a dangerous thing if you don't get it right. You got to be very, very careful with this. Here's an example, okay? Flipped on its head. Hopefully you can see this. I've kind of put 2 charts in here to illustrate the point. Let's say you're shorting the NASDAQ. Wow, you've got death wish at the moment, but let's say you're short. Who knows? Who knows where the market's going to go? Anything can happen, right? But let's say you're shorting it here. You added some. You have the same strategy every $10. Great, you're in your position now. You feel like it's going to roll over back to the VWAP. It doesn't. It blasts off into the stratosphere. All of a sudden, you are in a big losing position. Now, of course, you have a stop loss, don't you? Yes, you do, to manage the risk, to cap that damage. But you can see that you will always be in your biggest position on the losing trades, because if you're scaling in at worse prices, by definition, you're always going to have that full size clip on, and then it goes against you. Whereas you might be in some of the best winners or the winning trades with just a quarter on. So the maths of your system doesn't always work out. And so if you're just doing this, you're saying I'm going to scale in. Now, fine, if it was this, it's great. You've got your full size position on. But very often you're going to get winners that don't take the full clips, 4 clips. It's going to take 1, go your way. You're in a quarter size. That's not going to undo the damage that's caused by the catastrophic, not necessarily catastrophic loser, but big loser on a full size position. So that's something to be aware of. Now, something I didn't mention in the slides is that where you can mitigate that is you can say, hey, if price starts to go against me, or sorry, price starts to go for me, or a certain time period, I'm going to put the rest of the position on to make sure that I've got the full size position on. So there are ways and means of adjusting this strategy to kind of be a little bit more effective, but that's the big downside of this. And I think it's okay to have a blanket rule that says don't add to losers, because if I'm honest, I feel like it opens Pandora's box a bit. If you're adding to losers, you're kind of in the position where you're going, do you know what? I can add to my losing trades here. It just forms bad habits, I think. So I wanted to include it because it's okay. And if you're a different type of trader and you're trading on a longer term, you're trading on a higher time frame, you're trying to get a better position, then fine. I think as long as you have a planned zone to scale into, so you don't keep adding and adding and adding and adding. So you say, I'm adding in this position here. That's where the trade thesis is still valid. Imagine if it was a mean reversion type play. That's where I'm going to add. Or use it as a drill to identify problems. So what I mean by this is that, let's say you look at your trading journal and your stats, and it says, oh, I feel like I'm always a bit early on my entry or a bit late on my entry. Scaling, splitting up your order into chunks, especially if you're using fixed chunks like these $10 increments, can help you identify a problem with your entry skill and adjust it. If you say, hey, nearly always, I'm getting all 4 filled, right? Imagine you're going in normally in trading trading all 4 at point 1. And you're getting stopped out. And that's happening frequently. Like, what the hell's happening, man? This feels like a good strategy. If I look a couple of hours later, the market's mean reverted. I feel like I'm getting it, but I'm just kind of out of tune with my entry. Then you can say, right, well, what I'll do is I'll stagger my order out, $10 increments, $5 increments, whatever market you're trading, 10 pips, 2 pips, whatever instrument you're trading. And then you say, well, how many are getting filled? Now, if regularly all 4 positions are getting filled, you know that first impulse to take the trade isn't serving you. And so the solution is to say, this isn't a kind of a solution drilled webinar, but the solution, we may as well cover it. The solution then is to say, well, what I need to do is pump the brakes a touch. When I see the turn, I need to, whoa, back off on the market order, maybe put a limit under the market to capture that last little bit. Maybe I need to just hesitate a little bit, just step back. I'm just a little bit eager with pulling the trigger. And so it's a very good way sometimes scaling of identifying those little tweaks and adjustments you can make in your trading. So scaling in, be very careful with it. Plan zone, I think is a good tool to use as a drill to identify kind of entry problems. And as I said, and I want to mention it again, guys, please avoid blindly scaling into losers. You will blow up. And I have seen many traders do this. Sadly, traders who were well capitalized, pretty good traders most of the time, but I've seen one trader who was so convinced in his position, scaling in huge position, way more than he wanted. He was down significant amount, and he got away with it. It came back and he got away with it. And that was the worst thing that could happen to him, because all it did was it kind of built in this behavior that it's okay to scale in, and it's okay to just keep adding and adding. And often it's like walking through a field of landmines, right? You get away with it, and one day you won't. You be scaling and scaling, you'll be so big position, so vulnerable to a movement, and have one last little heavy day, and you'll be out of the game. So be very, very careful. Capital is the one thing we need to preserve as traders: mental capital, financial capital, and doing this doesn't do that. Okay, well, it doesn't help you with that. All right, next part is scaling, adding size. So I have it here. I'm going to put a slide up talking about this. So this gentleman, Tom Hugard, have I got? There's my camera there. Tom Hugard. He wrote this book, Best Loser Wins. Some of you know of him already. He is a big advocate, and I recommend the book, by the way. Good book. And actually, there were some fakes out there. It has to start with, you get it from Amazon. I think it's sorted out now, but there's some fakes, and it should start with Dear Markets rather than introduction, which is bizarre, right? People are scamming books now, but there you go. He's a big advocate for adding as the trade goes in his favor, so pyramiding into the trade. So when trades are going your way, the thesis is you add more size to make more from the winners. So if you go back to that £4 a point example, or 40 or 400 or 4p, whatever you trade, doesn't matter the size. You say I've added one, as it goes in my favor, add another, add another, add another. So the upside of that is you're in your biggest on your winners. If a trade is rocketing a lovely, beautiful trend day like we've had the past few days on the NASDAQ, not today, a few days ago, yesterday was right as well, but you get the idea. If you're adding size and your long position, you are going to be in a big fat position on your winners. Very nice. However, it leaves you vulnerable to noise and pullback. So how do we mitigate that? Now, there's no perfect solution. As a lot of trading is, you give with one hand, you take with the other. It's a balancing act and deciding what is right for your risk tolerance, number one, your mental capital, number two. Some people are very, very happy seeing a big unrealized P&L ramp up, ramp up, ramp up, and giving it all back. They're okay with that because they know that actually, if they do it enough times, that is going to keep going and going and going, and going to be able to take that nice unrealized, and going to get to crystallize that into an actual profit. Whereas some traders don't like doing that. They don't like seeing the unrealized disappear. And that's okay. Whatever trader you are, that's okay. You just adjust your strategy to suit. Maybe this isn't the way you trade. Okay, so scaling, adding size. So let's, and by the way, I've kind of simplified a lot of these examples as scaling it at kind of set points. Now, in the real world, in the real coal face, the front line, the trenches, as we are, you may want to adjust how you scale in or scale out and stuff. I get that, but I'm just kind of using it for illustration purposes. So imagine you're trading Tesla here. This is a perfect Krispy Kreme example. It's so nice. It's a lovely frothy cappuccino with a nice heart-shaped chocolate dusting on top. This is lovely, right? You're long 180, 178.50. You're adding every 150, $1.50 on this Tesla. This is Tesla, you can see. Great. 1, 2, 3. Wow, look at this. This is just brilliant. And your final trade even got a nice little extra bit of a Billy bonus towards the end of the day. It was a fantastic trade. It was an outlier. It would have been a humongous profit. And that's a perfect example, right? And that's what you're looking for. You're looking for these kind of trend dates that start bottom left, top right, or if you're shorting the other way around, of course, and you're adding as the trade goes in your favor. But these are rare. You and I both know these are rare. Trend days are less common than rotational days. Yes, I understand recently we've had a few in the NASDAQ, and market's been on a tear. Great. It's maybe a great time to operate in this way. But a lot of the times we get rotations. The market doesn't close at highs. It rotates back quite a lot. It doesn't open up at the bottom. It does its own little thing. And so you sometimes get things like this. Even a strong day where you're deploying a similar type of strategy, you add every $2. So you're here at 173. Let's say you're, by the way, sort of just for hypothetical purposes, you're kind of trading the opening 5-minute range break, right? So just a simple systematic strategy. You're in long here, adding, 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 adding. Brilliant day. You did it again this day, added, 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 added. Actually, that's not so great. You didn't get a final add, by the way, didn't quite get there. But now your average is kind of 176 because you've added here as your first clip, your second, your third, your fourth. This hasn't done you any favors. And yes, you've still made a bit of a profit, but it's not that great. You've given back quite a lot. And that's not a bad day, right? It's still an up day on Tesla. It's still gone from 170 print up to 177. That's a decent move. But because you've added too aggressively, these last kind of ads really screwed up the P&L on the deal. And another example, a normal type of day, again, Tesla still closed up on the day, right? Just about 175, closing up 177.50. If you were trading that same strategy, that 5-minute breakout type trade, 174, and at $1 higher, $1 higher, $1 higher, you're adding, you're expecting a really good trend day. You get just one final add here. You're in a big size now, 1, 2, 3, 4, 5, 6 position. I'm not necessarily saying, huge size, but big in proportion to maybe what you would do if you weren't adding, right? You don't have to, we're not taking huge risks here, but just for illustration purposes, right? You're now in the biggest size at this point, and that is the swing where it starts to get nasty. And the unrealized P&L is 6 times as much as it is when you're down here because you've got 6 times the position size on, yeah? 2, 3, 4, 5, 6. It's swinging back. That's a lot to tolerate mentally, and okay, the thesis is, well, actually, my average is going to be sitting at 177. So that's coming right back to break even after being a really nice winner. And eventually it comes back and, maybe you made 50 cents on that, but that's unpleasant. That unrealized P&L swing is unpleasant. So that's the downside of adding to the trade. These upper adds here just screw up the whole thing. They're a mess. They really add. I think this is why I'm going to kind of show you how I think you can avoid this or help to avoid this. Is these final ads are the things that mess up this strategy massively. And this is where, we can go wrong. We can be kind of adding. And those last ads really don't serve us. They're chasing. They're just not doing us so well. And they undo the good work we've done by buying at lows earlier in the day, right? So how do we deal with this? So one way of doing it, I've gone too far, is, if I get my slide, here we go. Here's the slide. Here's an idea. So the nemesis of pyramiding, as we just said, is adding too far. You extended, the move's going. You're adding a clip, and you're paying up, and you're FOMOing into the deal. It's just not the way to do it. So here's something to consider. I like to take the ADR of the instrument, which is the average daily range, the expected range of a day. Each instrument has an expected range of the day. So I like to use 10. So what's the average range open to close? So the candle range, we know the range, hope you know what the range is. What's the average over the last 10 days? Tesla, for example, in that date was $5.50. A little bit different. Maybe it's not so much now, but it varies, right? And it's adjusted volatility. And you take that for the instrument you're trading. If you're trading USD JPY, maybe it's 50 pips. If you're trading Euro USD, maybe it's 40 pips. Maybe it's 100 pips. Who knows, right? You know the instrument you're trading. You say, right, that's the expected. And I've done a webinar on this as well. So if you go on the YouTube channel, Pepperstone's YouTube channel, and have a look at using ATR, I think it's called using ATR. I'll go into a lot more depth on this. But hey, that's the expected range of the day, right? My expected range of the day is X. So what I can do is say, well, if I'm expecting $5.50 range for Tesla, normal day, no catalyst, no earnings, nothing surprising coming out, no Jay Powell saying something crazy. All right, anything around $5.50 is about what it's been the last 10 days, 10 trading days. Okay, I'll work with that. So now what I say is I won't add to the position in the upper 25% of that range. And you could say upper 50% of that range. So if it's already done, let's say 50%, it's already done $2, public maths, $2.25, right? So it's half that 550. Anything more than that, no ads. You add up to that point and you say, right, now I'm not going to add more, because you can see why. Because as you're adding to the position, the more you're adding to the position in the upper end of the range, the less likely it is to extend further. If the average expected range is $5.50 and you're buying when it's already done $5.50, you're basically saying, I expect it to do more than average. Now, it could, of course, market could do what the heck it wants, but you're in now dangerous territory. So restrict yourself and say, I'm only going to add to the trade in that 75% or in the 50%. So that means there's still juice in the trade. If I'm expecting the day to be a $5.50 range, I'm not asking for anything unusual. And here's what it looked like, right? So that was the example we just had. We're adding every dollar, fine, and you're adding and you're getting a really horrible fill right there at the top at 179.50. But you're being a good boy, you're sticking to your plan, you're adding to the trade, and it absolutely doesn't work out. Here's what you do if we deployed that strategy, the ADR filter. We'd say to ourselves, okay, listen, $5.50 is my expected range of the day. And again, you could use this on a currency pair, on gold, wherever you trade. I'm just using Tesla as an example, because there were three really good kind of different types of trading day to illustrate the efficacy of adding, right? So $5.50, so there's my range. So I extrapolate my range. I'm long one, I'm long again, that's fine. I'm long again. In this red area, which is the upper 25%, I don't know why I cut that off with the candle, but that's the upper 25%, right? That's 25%. So 75% of the range is up to here, this point. I'm not adding any more. Why? Because I expect that $5.50 is the range expectation. It'll be a bit more, could be a bit less. It's only an average. But the more I start adding to the trade near that ADR, the more I'm asking for trouble, I think, because I'm asking for more than really is average. And so I'm asking for it to continue way more than it would normally, in inverted commas. So I don't add any more to the position as we start to get to the upper end of that ADR. And in this example, I've got 3 ads. Instead of my 6, I've got 3. And how much more effective is this in that, hey, you haven't got to sit through all that horrible unrealized P&L drawdown. And actual facts, oops, didn't mean to do that. Apologies. In actual fact, now I've done all right on the trade. I've still been a nice little trade. $1.50 on that on 3 lots, because my average is actually 175.50. So just something to consider when you're adding to the position. It's tempting to go, yes, I can see that I'm going to make loads by adding, but just be careful. The market is still rotational. The market still operates within its boundaries. You are going to get those outlier days that just rocket up to the stratosphere, and that's beautiful. If you get one of those like that one we saw, and you can get all that position on, then lovely. That's just a fantastic outlier day. But it's the exception rather than the norm. And as traders, as active traders, which I know you are, that's why you're here. You're here to improve your active trading. You know that actually being more proficient on the normal days is what's going to move the needle the most, rather than the outlier days. Fine. Having a separate strategy for trend days, trend day enhancement, you're trying to really capture those trend days. That's one thing, but also recognizing, hey, I also need to protect myself a little bit. Going back to those top traders are talking about risk, it's a good way of being aggressive, but not so aggressive. You're going out, you're just like chucking the haymakers and leaving yourself vulnerable. You've seen those guys, right? Who do that. They're out there and they're just swinging, looking to land these big punches, but they leave themselves vulnerable. Right here, you're being aggressive. You're trying to add more size on, but at the same time, you're playing defense. You're not just leaving yourself wide open to a pullback. You're like, hey, I recognize this can pull back, but I still want to try and get as much as I can out of it. Okay, so how we do for time? We're good. Best practices. So be careful blindly adding to a position. We know markets rotate more than they trend. Plan your pyramiding strategy. Number 2, get aggressive early, then back off. So use that sort of chunking of the ADR and saying, hey, when it gets past 75% or whatever number, 50% might be more comfortable for you, I won't add any more. And being prepared to give back P&L mentally, because that's what happens when you're pyramiding to position. You're adding size, you're worsening your entry, and then as it comes back, it's more exaggerated. And it's a trade-off, just like everything in trading. And yeah, that's the slide for Tom Hugard's book, which looks slightly different, actually. He's got a quote on the top of this one, but you see it on Amazon. Anyway, so I do recommend that. And why I recommend that is because Tom talks a lot about adding to positions, and it's very apt for this discussion. Okay, so let's talk about well, before we move on, just final word on this. If you're if you're adding systematically, like every couple of dollars or every $10 or whatever, just accept that most trades are not going to work out. Just accept that. That's the game you're playing by adding. But the ones that do can be big winners. This is basically running trades plus, this is on speed, right? You're saying, okay, I'm running a trade, but I'm also adding to the trade. So it's a very specific requirement you've got from price. And understand that if that pays off, great, it's going to pay off beautifully, but it's not going to pay off most of the time. So understanding that that is the decision you need to make as a trader, and that's why it's not for everyone. That some people like that, some people don't, and that's the decision you've got to make. All right, so scaling out. Let's talk about scaling out. So I love scaling out. I think this is something, it's different scaling in, different strategy, different technique, but it's something that I think is so useful for traders. You don't have to be perfect with it. Your decision to close isn't as meaningful. Before I was saying, imagine if you've got one clip, like it's coming right up to a really big resistance level. You're long, you've got some unrealized there, but actually you think it's probably going to break out. The ADR suggests it could break out. The daily suggests it could break out, but it's a big resistance level, and you're fighting internally. Should I take it? Should I not? There's money in the bank. It's a big resistance level. Yeah, but it could break out. It's flagging, and it's very, very tough. It's very, very tough to go, I need to do this. If you can scale out, you can just take 10% off, 20% off, half off. It relieves the pressure and the anxiety of the decision. The decision is nowhere near as meaningful. Like, you know what? Yeah, that's a key level. It could roll right back. I'm going to throw half out here. I'll pay myself that half and I'll see what happens. And if it breaks out, you've still got half. If it comes back, you've banked half. It's a nice position to be in. And you can use this very, very effectively to soothe that kind of internal dialogue, alleviate some of that anxiety and pressure that we sometimes have with positions, and soothe that chimp coming from the Chimp Paradox book by Professor Peters, if I remember rightly. Someone can correct me on that. But yeah, that kind of voice that we have sometimes when we're in our trading. So let's take a little bit of a journey. Imagine you're a short Dow, right? And Dow's completely opposite to NASDAQ at the moment. It's completely out of sync. But let's imagine you're a Dow trader, you're short nice and early. Let's say you short at the UK Open, 8 o'clock for whatever reason, and you're sitting with a trade, but you're in one lot. So it comes down, you're like, I'm being a good boy or girl, and I'm holding this bad boy as far as I can get it. Right, it's going lower, You're watching that and realize P&L, lovely, jubbly, here we go, rolling down nicely. Get that big exhaustion candle. We've talked about exhaustion candles before, even done a webinar on that if you want to dig into that. And you go, oh, exhaustion candle, big move. Oh, maybe I should be thinking about closing this. And market kind of does a little dip here. You go, well, I'll hold it. It hasn't pulled back much. Rotates back over, double bottoms. You're like, oh, extended, exhaustion candle, big move. I really should take it. And you go, no, I feel I should hold it. And you've got one clip on. You kind of we're in this horrible position where they're both right. Like that's the extended move. That's a double bottom. We've had all the things that would suggest that's a short-term rotational point, right? This is technical analysis 101. Okay, so you're battling. Oh, do I fight and hold it? Do I do this? And maybe you don't. Yeah, I'm going to be good. I'm going to hold it. Then the market rips back up. Damn it, it's covered the view up. I'm going to close the position now. So you give back half your position. Where you've been from here. You've had all this unrealized P&L. We're trying to be good and trying to hold it. You only had one shot, so it was all in or all out. You decided to run it. It didn't work out this time. Damn it. Then what happens? It rolls back over again. You go, I'm going to reshort it. I'm going to get back in. I knew it was going to go over. You're shorting it here. Pots back up. You stopped. You get the idea, right? What is a nice, beautiful trade that started out so well has turned into something that has actually been a bad trade for your P&L, a bad trade for your mindset, all because at this point in time, you didn't have the ability to just take one off or just take a portion off. It was an all or nothing decision. And they were both good decisions, sound decisions in trading principles. Double bottom after an exhaustion flush after a big move. Man, the chance of that rotating back is pretty high, right? But higher time frame, could it close at lows? It could easily do that. So you kind of really struggling internally. And this thing can happen, right? You close out position, it comes back, you chase it, you do this, or shoulda, woulda, coulda. So it's much easier if you've got ability to scale, you peel some off, right? You go, listen, that is a bottoming pattern. The likelihood that rotates back is reasonably high. I still think I want to get short and stay short. That's fine, hypothetically, but I'll peel some off. So let's talk about this. Best practices here is to Plan your scaling out strategy, excuse me, before the trade. So decide on what you're going to do and say to yourself, hey, there's a couple of options here. Do I scale out at a key level or some price action? So an example of that Dow, excuse me, hypothetical trade. Hey, extended move. We've had, a 300-point move to the downside before the US Open. We've seen kind of some reversal type patterns in price action. That for me is enough to scale, and that goes in your plan, right? So there's your price action, your fixed level ADR, so using that type of thing again, time based. So maybe you scale out just before the US Open, or before the US close, or for European close, or any of those major points before CPI or big data, fine, or key levels, right? You've got a key resistance level, you see that, price gets to it, I'm going to peel some out. So planning it helps kind of execute this more effectively. And then you can go, right, I'm going to start this ball rolling or start my scaling journey by just leaving a small runner. So you trade it as you normally would with one off, one on, just all in or all out, but you leave one. You say, okay, you know what? I feel like that could run a little bit further. And what you're doing here is you're just exploring the how price behaves after you've exited. Because very often we log our results, we see the results. We don't tend to know what's gone on after the trade is finished. We don't see that data unless we're logging it specifically. We don't see. Leaving a small runner, a very small position. If you're trading with someone like Pepperstone, you can do this. You can have a very small position so you can scale out kind of quite good and leave a little one on. And then that gives you data and says, well, actually, if I hold my trade for another hour, another 10 minutes, another 5 minutes, another day for a swing trader, how does that affect my performance over the last month? And you get the data there in black and white because that small runner has shown you, actually, you know what? 50% of the time, I get a lot more out of it. Is that enough? Do I get a lot more? Is it worth holding? And you can run the numbers yourself and say, well, actually, you know what? I need to hold trades a little bit longer, or I need to leave more of a bigger position on to run. You can do that analysis yourself. Except it'll never be perfect. The old, we've all been there. I'm going to hold this trade. Gets to a level, bounces off, comes back, stops us out. I'm going to close this trade at the key level, comes down, rips through. There's a big trend day. The market's the market, guys. We know how this works. It will often test you to your limits. So just accept it's never going to be perfect, but that's okay, right? We're not trying to be perfect. We're just trying to do the best job we can. This is an interesting thing. So leverage on your edge. So having a discussion with a trader at the moment who's very good at getting this first pop, right? He's very good at spotting the turning point in the market to the downside, getting that first pop, and then afterwards, he's trying to hold for runners sometimes. Sometimes he gets them, sometimes he doesn't. But he's good at kind of reading that stretch spring to the downside, releasing the spring, popping back up. If that's you, if you're good at doing that, if you find that's something you can repeat over time, then you can scale aggressively into that first pop and leverage on your skill set, right? So if you're maybe not so good at spotting the trend day move, but you're okay at spotting that short-term kind of spring popping back up, then you can scale aggressively into that and say, right, I've got the entry, pops back up, take 3/4 off, let a quarter run and see what happens in the lap of the market gods. So there's ways you can do that, can leverage on your edge by scaling. That's the advantage of scaling. You can adjust your position to suit. And you can also work around a core position. Okay, so the core position thinking is that, and this is a lot of traders do this. A lot of traders do this. You'd be surprised. They have a thesis, right? The thesis is, hey, I believe we're going to go from, a very simple thesis, going to have a trend type day, or we're in a bull market. I'm going to want to stay long off the support level, whatever it is. So you have a position to express that thesis, but you put size on and peel size off depending on price action at the time. So you might buy at support, then price kind of goes your way, starts to flag, you buy some more, and it's a flag trade now. That flag then kind of moves up higher, you peel some off, it rotates back, finds a base and support, you add a bit more on. You've still got your initial core, but you're peeling some on and off as price action determines. You never remove your initial core position because that's your North Star. Your North Star is bullish. This market, I believe, is going to close at highs. Yes, you have an ultimate stop for that, of course, but you're peeling size on and off as the market's going in your favor. This can be a good way of again, that internal dialogue of I believe the market is bullish or I believe the market is bearish, whatever you're trading, I want to position for that, but I also want to take advantage of being able to perceive short-term price action and short-term nuances and subtleties and supply-demand imbalance. Great, work around a core. Get your core position on, set your core position size, set your max position size, and work up to that and back. So simple hypothetical terms, your core position size is 1. Your max position size is 3. So you have one on, you see another entry, market goes up, comes back, finds some support. It's above your level that you bought at before, finds a little bit of support. You add another, comes back up, flags, you add another. Pushes to your highs, exhaustion bar, you peel 2 off. You still got your core. Comes back down, tags VWAP, you add another. Okay, I understand I'm kind of cherry picking this as a really perfect example, but you get the idea, right? You trade the core separately to the ads. They are separate. And I'm always a big advocate of saying you treat them separately as that. Don't bundle them all in and say, well, I've added 10, I'm at 20, I'm at 30 here, my average is 20. No. You say that my trade at 10 there has got to stop at 8 and now it's break even. My trade at 20 now has got to stop at 18. I'm looking for 28. You look at them as separate independent trades. Yes, they all combine to the cumulative P&L one way or the other, but I think that's a better way of looking at it. It's personal, of course. That's only the way that I like to look at it. You choose it yourself, but I like to think of it like that. You kind of have those individual trades that must stand on their own 2 feet, have their own risk parameters set with that trade, their own targets set with that trade, rather than bundling them all into one. And then the final thing is to plan how you working out the additional clips. Will you trade on price action, like I suggested there, flag, a pullback to thing? Will it be a systematic every X dollars you move or every pips move, time, every 30 minutes? How will it be? I don't think that's really the right way to go. I think you're a better trader than that, than using that kind of fix. I'm just going to do blindly whatever time of day it is every half an hour. I think that you can be more nuanced and subtle than that, but it's one way of looking at it, right? Okay, so yeah, one thing to point out is thinking what your North Star is. Okay, so your North Star is, hey, I'm long, my core's long, I'm selling into strength, I'm buying into weakness, right? So you're trading that spring stretch, I'm selling some of that off, I'm keeping my core, I'm buying back into weakness, I'm selling into exhaustion, buying into support. And if you can approach a day like that and you get the right type of day, it might feel like, well, if I put a whole position on at the beginning of the day, it would be great. Yes, but you're kind of protecting yourself a little bit. And just like Stanley Druckenmiller was saying back there in the initial quote, you're able to manage your risk a little bit more effectively. When you feel like the market's a little bit frothy, you're light. You've got your core on still, looking for the bigger move, but you're not adding an incremental size on. When it pulls back, you're still bullish and you're finding a decent level of support, wicks through. You think, oh, it's a nice little trade there. Then you can be more aggressive and add more risk on. So it's playing that game and leveraging your underlying feel of where trends going and where price is going, but your ability to read short-term price action, which is the skill you're kind of developing over time, right? Example in NVIDIA, if you're a swing trading that, you'd be peeling stuff off it, buying back a VWAP perhaps, peeling stuff off here on the gap up. Yeah, you're not going to be perfect, never going to be perfect, but that's how you'd be trading it, right? And keeping that core position on. All right, so main takeaways, and I'll take some questions from you, ladies and gentlemen. Okay, avoid scaling in blindly. So going back to scaling in, please, I am begging you, please do not scale in blindly. It is a recipe for disaster. I've seen many traders do it. I've done it myself in my early days. You may well have done it. It never, ever works. Well, it does work, and that's the trap, because you do it and you think, I got away with that. I'm a genius trader. I'll do it again. And the next day the market goes, sir, step this way. There's a trapdoor right there, and you just go dunk straight on a trapdoor. So really, really, really careful. That is the real killer of traders. Consider a zone of scaling for and against. So where you scale in, if you do scale in, and I also suggest maybe not doing that at all. Scale in, scaling out. So as it's going against you, as it's going for you, where am I going to scale position? Align how you'll scale with your broad trade idea. And some trades are just A to B, level to level, no scale, no adding, nothing. I'm in, I'm out, and that's fine. That's fine. But understanding some trades may well require a little bit of nuance. I want to add some size. I want to peel off some size. I want to be more aggressive when I see this. I want to play defensive when I see this. That's the nature of the screen-based trader. Except there's a trade-off. Something's good, you take away from something else. You gain something here, the chance to make a really big amount of money in one day, but the chance of that coming back and stopping you out and taking all that unrealized away quite high. It's a trade-off. All trading is a trade-off. Figure out what's important to you. Use scanning as a kind of diagnostic tool to diagnose a challenge and say, hey, you know what? My entries are a little bit this, a little bit that. Okay, I'll scale and I'll see if I can do that. And we gave an example there of having a runner, holding a runner just to see if you are early with your trade exits. And some final thing here before I get to a couple of questions in there. Just stick your questions in the Q&A, guys, if you've got any questions. Is often the best action isn't the one that gives you the best return over time. So what I mean by this, and this sounds counterintuitive, right? So you may have a strategy that is effective and the equity curve is great, but it's got this big, brutal drawdown. There's no way you're going to stick to it. There's just no way. Mentally, you're not going to be able to stick to that big drawdown to get that big return. So sometimes trading suboptimally to smooth out the equity curve a bit and not have the big swings in P&L to give yourself a little bit more peace and maybe make less at the end of it, but that's better for most people. And so often the best action isn't to optimize fully for profit and equity curve and all this stuff. Sometimes it's for peace. It's for anxiety level of trading. It's for discipline and all that other stuff that goes with it. So sometimes think, hey, this might not be the best thing to do P&L wise, but it's certainly the best thing to do for me. Scaling some off here helps me sleep better, helps me feel like I'm banking something on the trade. And yes, maybe you want to trade the whole trade and have all the position on a big fat position that goes from here to here and you're a hero. But you know what? Just take some off. Take some off, bank some. You can become a different trader over time. You don't have to plant your flag in the ground and say, this is how I trade. You adjust, you adapt, as you increase your screen time, experience and development and knowledge, and as the market changes. So just something to consider there. I think is well worth mentioning. A little shameless plug, guys. I know many of you are on my email list. If you're not already, do sign up to it. Send an email out every day. Talk about all sorts of stuff, interesting stuff, stories about different traders, trading strategies, ideas, risk management, etc., etc. We've got well over 10,000 in there now, growing massively every month. And also, don't forget to check out the guys who make this possible. Of course, Pepperstone. They've got 24-hour trading on many of the US CFD shares now, which is worth checking out. All right, so I've lost everybody here. There we go. Q&A. Let's have a look. How long we got? We've got a few minutes, ladies and gents. Fire away. Victor, good to see you. Familiar faces. It's good to see you guys here. Okay. This was an early question, actually. Maybe I didn't answer this. Let's see. Maybe you're going to answer this later, Victor says. But scaling to losers, do you use the same? It just sounds, oh gosh, it just feels in my heart there, Victor, scaling to losers. That's why I don't like it, right? It just feels like that's a North Star I try to really avoid. But okay, let's answer the question. And that's why it's double check, like be careful with it. And even Paul Tudor Jones, remember that documentary he had 1987? Not 1984, something different. 1987, I think it's called. He has on above his desk losers, average losers. So mindful of that. But answer your question. Scaling to losers, do you use the same stop loss for all chunks or do you reduce stop loss and improve R&R? The thesis behind the setup is the same for all chunks. So stop loss might be roughly the same price instead of fixed stop loss at lower prices. So Victor, I think you're asking there, do you use a stop for each chunk or do you bundle it into one? I think there's merits for both, right? There's merits for both. But I would ask you this. If you are trading in position one, right, and your stop is there and then you're trading again, why are you taking a stop loss? And you might say, Mark, I'm managing my risk. I'm being a good boy. I'm making sure I cap my losers. And I would say, yes, Victor, that's a very good boy. Well done. But I would also say to you this, the idea of the trade, if you're buying again, your thesis is still valid, right? You're still buying on that flush, on that support. And so really, you kind of want to wrap them all into one and say, I want to buy in this area. I think my thesis is wrong, where your stop should be in this area. And so I'm going to operate it like that. And so I guess the answer is you could use either, but just remember that wherever you have your stop should be where the thesis of the trade you believe is no longer valid. That's the key point of a stop. Yes, the secondary aspect is to cap losers, of course. That's the whole point of a stop, but it should be in a position where you no longer think your thesis is valid. So if you're doing that, you're buying, you got to stop, and you're buying again and got to stop, then you need to rethink what you're. I don't think that's what you said, but just saying that if anyone's listening. I hope that's helped. Okay, Suresh. Good to see you, Suresh. Hi, Mark. Great session. Thanks. Appreciate that. Quick question. When scaling in, do you suggest treating each and every scale in, very similar question, you suggest treating each and every scale in a trade as a separate one? I mean, bracket order of stop loss and TP for each one. Like I said before, Suresh, I think it's up to you, but just be mindful about where your stop loss is and why the stop loss is there. You can do that, and that's one way of kind of. And the advantage of that, Suresh, and those of you thinking about this in your brain will get this. If your price is going against you, you get filled in that final clip, like that Tesla example, that fourth clip. It just pops back up to where it was. You're cash flowing that one trade, so you're playing very, very defensively there. And I get why you might want to do that. You might want to say, "Oh, I want to make sure I'm banking something." But the trouble you've got is that when the trade goes your way, you're in your least size. When the trade goes against you, you're in your biggest size. Just go back to some of those first principles and think, well, if I'm in 4 positions and it keeps going lower, that's a big hit. If it goes my way and I just get one, I'm in a quarter of the size. If I get all of them and I'm scaling them out as it goes my way, I'm still in small size. So just something to be aware of there. There's no silver bullet. And I think you know this as well. It's like experiment, try, test, but always take a step back, guys. Always do this, okay? And I like to do this. Step back and go, is this something that makes sense logically? Like if I did this for 1,000 trades, would I get the results I'm expecting? And sometimes you look at it and go, I've got to be a bit of a market genius to make that work. And that's not going to happen. And sometimes you look at it and go, actually, I don't have to be that effective for that to work. That scaling strategy, that money management strategy is quite effective. So I'm going to deploy that. So that's just something to kind of consider whenever you're coming up with a new strategy, especially a risk management strategy. But thank you, Suresh. Rowie says, 2 things. I kind of did not understand the core and max. How do you get to max 3? I'll explain that. It's a good question. Number 2, I recognize I flip strategies exactly because of the thing, that strategy. Have I got balloons on my camera? I have, yes. Didn't really mean to get balloons. I need to change that setting, don't I? I kind of do not understand the core max. How do you get to max 3? And I recognize I flip strategy exactly because of the thing that strategy doesn't happen on one market anytime. Do you think would it be better to set up a scanner for few assets? Any recommended? Let me ask a question one first, Rowie. So core position, you decide the max. So what I mean by that is, what's your core position and what's the maximum position you'll hold? So if you say my core is going to be 1 unit, that you're always going to hold 1 until the end of the day. That's your decision. You've decided that's your decision to make. You're long, you hold 1, but you also allow yourself to add 2 more to get to a maximum of 3 if you see a short-term price action pattern intraday. So let's say you see a flag, you've got your core, you forget about your core, right? That's under control. Your stop is at lows, fine, you're going to close at the end of the day. But you see a short-term flag, you want to take advantage of that. You don't want to take the core off, you can add another unit. Now you're at 2. That flag plays out, then maybe it comes back down and finds some support. You still like the trade. You've got your core, you've got your 1 extra. Now you want to add 1 more at the support level. Now you've got maximum 3. You're not adding another 4th. You've said max 3. That then breaks out to the higher side. You get an exhaustion candle. Intraday still, it's still midday, could roll back. You peel those 2 off. You pay yourself for those 2. You keep your core. So your core is your min, your max is how much, and that's for you to decide, right? I just plucked out the air and said, maybe you go to max 3. Hopefully that makes sense. This question, do I flip strategies because of the strategy doesn't happen on one market? Okay. So I think the question you're asking here is, you have a strategy. It doesn't happen all the time on one market. Do you think it's better to set up and look at other markets? I think that's what you're asking, Rowie. Yes. You have 2 choices, I believe. You become a strategy specialist, you become a market specialist. It's not as black and white as that, and you can blend them a little bit, fine. But I think that's where you get the best results. So if you're a strategy specialist, you can deploy that strategy on similar markets, right? So I don't know, let's say you're trading, I don't know, intraday bull flag, right? Whatever. And you go, I hardly get these very much. Well, maybe you're watching NASDAQ, but maybe that's also valid on the DAX. Maybe it's also valid on Dow. Maybe it's also valid on gold. Maybe it's also valid on crude oil. Maybe it's also valid on Tesla. Maybe it's not valid on Bitcoin, for example. I'm plucking markets out my ear here. But you'll become a strategy specialist rather than a market specialist. And so you spread your kind of net wide for similar markets to deploy that strategy. A great example is if you're an earnings trader, a news trader, a gap trader, you don't trade just one market because the chance of that gapping is very, very slim. But during earnings season, you say to yourself, hey, I deploy a catalyst based trading strategy here. I look for gaps and I've got a basket of stocks I screened for. Versus I'm a DAX specialist, I'm a Dow specialist, I'm a USD JPY specialist, and you watch the nuances and subtleties. You understand the volatility expansion, contraction, the rotational nature of the market. You've got the ADR embedded in your skull. You just know that market. And so you start to see little subtleties that people who aren't specialists don't see, and you can trade those. You can trade mean reversion, you can trade A to B trades, you can trade the trend days. Never going to be perfect, of course, but you become a specialist in that market. So, long answer to long-winded answer to I think you could scan for more. There's no, you can always go back again. Don't spread yourself too thin. You know, man who chases two rabbit catches none and all that, but also beware I think you might get more reps in. And also he says, by the way, the reason to turn it off, turn on me after 2 hour, better to implement the scaling out strategy. I think you're saying there that it starts to go 2 hour and rotates back. Should I scale? Yeah, listen, if you're getting something where you find the market going 2 hour in your favor and it's coming back, the first port of call is to make sure you get some off at 2R to see if that's correct. And then you've got two spreadsheet columns that says, that's my first exit, that's my second. Hey, my second exit is always coming back on me. Well, in that case, I'm going to take it all out at 2R. 2R is going to be my max. And then also just checking where 2R is in the range of the day. It's so overlooked and it's easily done. You know, what's your expected range of the day? Maybe the way you trade, Roby, is you see that push off the low, you see some momentum, you trigger into the momentum, you buy the offer, it starts to go your way, your stop is kind of fixed. 2R brings you normally with the trading day's range. You don't realize that, and it's reversing on you, and actually that's the normal day. So we're also sort of looking into the perspective of not just your trade, but the price and expected price in general. Well, final question here from Hiran. It says, hello, Hiran. It says, hi, Mark. A long time ago when I started trading, I have mastered what is the best time of day to trade for Forex from your YouTube video. Good. I'm glad, Hiran, because that is something that is very, 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 very underrated. Time of day to execute trades, to look for specific patterns is one of the biggest levers I think you can pull. And I've talked about that many times, and you kind of focus your energy on a time of day for reversal, a time of day for momentum, and you know that for the market you're trading. So very, very pleased to hear it. All right, ladies and gents, thank you so. Oh no, some more questions. I do apologize. I've not scrolled down. Victor says, "Cheers, Mark. Very informative and food for thought." Thank you, Victor. Roe, yes, thank you. Appreciate you. Appreciate you, pal. Too. All right, thanks, ladies and gents. Hope you've enjoyed this one. I shall be back again, I'm sure, with more. Take care. Keep yours managed. Bye bye.